Bismillahirrahmanirrahim. In the previous class, we discussed about the cash flow statement in detail. Today, we are going to start the next chapter, that is week 5. It is accounting cycle and accounting international accounting principles, that is GAAP. Now, what is accounting cycle? I think you people know about accounting cycle. The accounting cycle is the name given to the collective process of recording and processing the accounting events of a company. It is basically a complete process, a complete collective process of recording business transaction and then processing these business transactions of a company. The series of steps begin when a transaction occurs and end with its inclusion in the financial statement. These steps will start when the transaction occurs and it will end when this transaction will become part of the financial statements. Either it will become part of income statement or balance sheet or cash flow or statement of owner's equity. It will be included in all this transaction. Maybe some will affect the balance sheet and income statement. Maybe some will affect the balance sheet and the cash flow statement. Maybe it will affect the balance sheet and the owner's equity statement, whatever that is. The sequence of 6 steps in processing of financial transactions from the time they occur to their inclusion in financial statements. We call it accounting cycle. Pertaining to an accounting period, and this will relate to one accounting period. These steps are: analyze the transaction as they occur. The first step is we will analyze the transaction. Then we will record these transactions in the journal. Then post debits and credits from journal entries to journal ledger. Then from journal we will post these transactions to ledger. Then there will be adjusting the assets with a trial balance. There will be adjustments. Then there will be financial statements. We will prepare financial statements, and then there will be closing the temporary accounts. Here, in between, some steps are missing. We will discuss it in detail here. Now look at this. The first step is analysis of business transaction. We will analyze the business transactions. Then we will post them to journal, journalizing the transaction. Then we will post to ledger accounts. Then we will prepare the trial balance. This is called unadjusted trial balance. Then we will make adjusting entries. Then from adjusting entries, we will make adjusted trial balance. Then we will prepare financial statements. Then we will make closing entries. There will be closing entries. Then post closing trial balance. After closing entries, we will make post closing trial balance. And then the last step, it is reversing entries. This reversing entries, this step, this is optional. If you want, well and good. If you don't want, it's fine. So these are the 10 steps. So now we will discuss these steps in detail. Now the first step is identifying and analyzing business transactions. The accounting process starts with identifying and analyzing business transactions and events. First, we will analyze business transactions and events, whether it will affect any account or not. Not all transactions and events are entered into accounting system, just like I told you. Out of these transactions, maybe some transactions will be entered into the accounting system. There will be some transactions which will not be entered into the accounting system. Only those that pertain to be business entity are included in the process. For example, a loan made by the owner in his name that does not have anything to do with the entity is not accounted for. Now, the owner made a personal loan. Personal loan means he took a loan for his family use. Now, this thing is not related to the business, so it will not be accounted for. We will not enter into the accounting system. Why? Why? This is a personal loan. This is not for the business. The transactions identified are then analyzed to determine the accounts affected and the amounts to be recorded. After analysis, if the transactions relate to the business, then we will analyze that this transaction will affect which accounts and what are the amounts to be recorded. Suppose the owner invested cash in the business. So cash to capital. Now these two accounts will be affected. We analyze that these two accounts will be affected. What is the amount? $1,000. So in analysis step, we are analyzing this thing, whether it is an entry which we will record or it is not an entry which is related to our business. So when the owner invested business, we analyzed it. Yes, it will affect our accounting system. So which account will be affected? Cash will be affected, capital will be affected. What is the amount? 1,000, 1,000. So we analyze this thing. The first step includes the preparing of business documents or source documents. Now here, what will be the source documents? What will be the business documents we will prepare? A business document serves as the basis for recording transactions. Now keep in mind one thing. Suppose we purchased stationery. So stationery will be debited, cash will be credited. Now when we purchase stationery, so we paid money. Do you have any proof of this, that you paid money? Yes. The stationery seller will give you a receipt. When you paid cash, he will give you a detail that these items are purchased and the price of these items is this and the total amount is this. This is called cash memo. When you paid cash and you received a receipt, that receipt is called cash memo. Now this will be the base for this transaction. This will be the source document. From this document you will pass this entry. So this is the first step in which we analyze the transactions, whether this transaction is the business transaction or this transaction is not the business transaction. This transaction will affect which accounts and what will be the amount of that transaction. Now, after analyzing, what will we do? We will record this journal entry in our books. A journal is a book, paper, or electronic. It can be a paper book, it can be electronic book in which transactions are recorded. We will record transactions. Business transactions are recorded using the double entry bookkeeping system. You know about this thing. That we will record this journal entry using double entry bookkeeping. They are recorded in journal entries containing at least two accounts, and you know, one transaction, it will affect at least two accounts, one debit and one credit. One account will be debited and the other account will be credited. To simplify the recording process, special journals are often used for transactions that reoccur frequently, such as sales, purchase, cash receipts, cash disbursements, etc. There are some special journals in which we are recording these journal entries. Sales ledger, purchase ledger, sales return journal, purchase return journal, cash receipts, cash payments. These are called special journals. A general journal is used to record those that cannot be entered in special books, and those transactions which are not recorded in special journals, we will record it in general journal. Transactions are recorded in chronological order and as they occur. Chronological means date-wise, order. Hence, journals are also known as books of original entry. And this journal, it is called books of original entry. Then from journal, we will move towards the ledger. We will post the transactions from journal to ledger. Also known as the book of final entry. A ledger is a collection of accounts that shows the changes made to each account as a result of past transactions and their current balances. Now you know about journal entry. This is journal entry. Stationery to cash, cash to capital. Now there will be a T account for all these. This is cash, this is capital. Cash will be debited by 1000. Capital will be credited by 1000. So this is basically the ledger, which shows a summarized, which shows a classified record. Not summarized, it shows a classified record. So classification is made in the ledger. Okay. This is the close of classifying phase. After the posting process, the balances of each account can now be determined. Now when you enter the transaction in the ledger, then we will balance these ledgers. 1000 is cash and capital is 1000. You know about the balancing. For example, all general entries made to cash would be transferred into cash account in the ledger. Increase and decrease in cash will be entered into one ledger account. Thus, the ending balance of cash can be determined. Now see, here is another transaction. Stationery. We debit, suppose we purchase stationery whose value is $100, and cash will be credited by $100. So we will debit stationery by $100 and we will credit cash by $100. Now what will be the balance? 1,000 minus 100. So the balance, it will be 900. So in this way, we'll make all these accounts. So here he's talking about this thing, cash accounts in the ledger. Increase and decrease in cash will be entered into one ledger account. Just like this, increase in cash, decrease in cash. And then at the end, thus the ending balance of cash can be determined. And then after that, after the increase and decrease, this is the ending balance of cash. Now the fourth step is unadjusted trial balance, or simply you can say trial balance. When you will post all the journal entries to ledger, the next step will be you will make a trial balance. The trial balance is preparing to test the equality of debits and credits. We'll make the trial balance, so it will tell us about the equality of debit and credit. If debit and credit are not equal, so means there will be some mistake. All account balances are extracted from the ledger and arranged in one report. Now these balances from ledger, we will make a report of these balances, and this report of balances, it is called trial balance. Afterward, all debit balances are added, all credit balances are also added. Total debit should be equal to total credits. When errors are discovered, correcting entries are made to rectify them or reverse their effect. If there is some mistake, so then what will we do? We will pass correcting entries. Take note, however, that the purpose of trial balance is only test the equality of total debits and total credits, and not to determine the correctness of accounting record. It is just this trial balance, it will just tell us about the equality of debits and credits. It will tell nothing about the correction of the accounting records. Some errors could exist even if debits are equal to credits, such as double posting or failure to record a transaction. Now see, there will be some mistakes in the trial balance. Both sides will be equal. Suppose this is a trial balance. Debit is 1 lakh. Credit is 1 lakh. Now suppose there was an entry, stationery to cash, 100, 100, 100 debit, 100 credit. Now you passed this entry twice. When you pass this entry twice, this trial balance cannot identify. Why? 100 will come to debit side, 100 will come to credit side. Now again we record it, 100 debit, 100 credit. So see what will be the total balance. 1 lakh, 200, 1 lakh, 200. So see, trial balance is balance. We record an entry 2 times, but still trial balance is balance. So it will not identify these types of mistakes. Another thing, suppose you did not record the transaction. Suppose we didn't record this transaction. So when you didn't record, again, debit is equal to credit. So these types of mistakes, trial balance is not discovering. Some errors could exist even debits are equal to credits, such as double posting or failure to record a transaction. Inshallah, in the next class, then we will talk about the other thing, the other part, that is adjusting entries, adjusted trial balance, financial statement, closing entries, and post closing trial balance and reversing entries. Assalam.